All right, looks like we have a lot of people getting logged in here. So thank you again for joining JMT Consulting today for our webinar over nonprofit real estate, cleaning up from COVID-19 with George Grace. My name is Megan Mediola, and I am a regional marketing coordinator here at JMT. I'll just say just a few words of intro here and then introduce George to you all and let him take over. This webinar is sponsored by JMT Consulting. We are an ERP and financial management solutions consulting firm. We have over 28 years of experience specializing in nonprofits, and we partner with a wide variety of software partners to find the best solution for your nonprofit. So just a few housekeeping notes before we get started. If you have any questions during the webinar, please go ahead and submit them into the Q&A section on your control panel. We'll get to as many of those as we can throughout this webinar, so please don't hesitate to submit all your questions as they come to you. Also, today's webinar recording and slides will be emailed to you within 24 hours following the conclusion of the webinar. Now I wanted to introduce you all to George Grace. George has over 33 years of experience in commercial real estate. He began his career as a civil engineer after graduating from Cooper Union. He received a law degree from Fordham University and an MBA from the University of Chicago. In 2012, George achieved the designation of Counselor of Real Estate by the National Association of Realtors, which signifies a depth of knowledge, experience, and integrity. George has been involved in a wide range of consulting and brokerage assignments. He is also chair of CMCCS Charter Schools in the Bronx, which is among several other charitable boards on which he serves. And with that, I'll go ahead and turn it over to you, George, to get us started.
Well, thank you very much, Megan, and welcome everyone. My thought in giving this presentation is to give sort of a wide breadth of what's happening and try to trim it down to the things that my clients are finding to be difficult to understand and to deal with. So, and since COVID-19, obviously the world has changed, and hopefully this slide will move. So this is what I hear from everybody. Real estate's our single largest expense after personnel, but it's the single largest expense, one-time expense. And the revenue sources and the donations are sinking like the Titanic. Help. And what we do is renegotiate leases. And leases is not the only type of real estate that nonprofits own, but it's one of the most essential. So people are happy when they have a new lease and they gives them some breathing room. So that's what we do essentially. But let's start back with what is nonprofit real estate. You know, that is such a huge term, and it's such a huge world because you have hospitals and you have education facilities. I represent a handful of law firms that do representation of indigent criminal defendants. They're a nonprofit. They have leases in New York. I have other nonprofits that own large pieces of land. I've done work, you know, for the Children's Aid Society, and you know they had a large piece of land. So there's a wide variety of what we term nonprofit real estate, and it can be and ranges from residential to commercial to industrial, and all of the above. We're going to focus today on the two things that I think are most common: leases and owned property. So typically, many, I would say the majority of nonprofits lease space, especially I'm based in Midtown Manhattan. The majority of the deals that I deal with in Manhattan are leases. But once you get outside of Manhattan, it's owned property is much more common for nonprofits. But the value of owned property and the value of property in general is driven by the leasing, the value of the leases that underlie them. And most of the tenants and nonprofits that I deal with are all, that do have leases. they, you know, their question is, you know, should I pay my rent? Should I not pay my rent? That's the fundamental question that people are asking me now. And so that issue affects values of property. And in order to negotiate with your landlord, you need to understand their position as well. But before we get to that, there's more fundamental issues that people are dealing with. You know, how do we get back to work? How do we get back into the workplace? And every state is doing something a little different. New York, Governor Cuomo has divided the state into different areas, and depending on the a variety of factors, they're opening those areas up for business. New York City is one of the last places, but one of the issues that, again, people are asking about that affects real estate is, how do we get our people get them working in a safe environment? So there's been a plethora of webinars on this subject, but I'm just going to go through very quickly, just in case you haven't heard one of them. I mean, they're all over the place, but buildings have increased cleaning. The building I'm in at 232 Madison, they have a whole new regimen about cleaning the elevators. They have a regimen about how many people can go in the elevators, where you can stand in the lobby, how many people can stand in the lobby at any given time. So it's very regimented about it. And then, you know, just getting up and down the elevators, which is a critical part. They are limiting the number of people that can do that at any given time, and everybody has to wear a mask. So a lot of landlords are going to touchless entries, so you don't have to touch anything. Companies are staggering work hours so that they can keep social distancing and not have everybody in at the same time. Obviously, social distancing, they're doing that with furniture, and they're putting up plexiglass protectors around desks. Masks are essential. My wife is a nurse, and she keeps telling me about wearing a mask 24 hours a day is awful. And, you know, not that she doesn't do it 24 hours a day, but, you know, she has 12-hour shifts. They have to wear a mask. It's not a great thing. But for now, it's essential. And then the other issue, you know, everybody talks about the building and how we can make the building safe and the workplace safe, but nobody's really addressed the issue of how we get to the workplace. And that's probably a bigger issue that I deal with is, okay, so we have a safe workplace. Can people drive? Again, if you're in a place like Manhattan where commuter and commuter rail and subways are the main means of transportation, it becomes an issue of, well, how do we get people to that workplace? So those are all issues that underline real estate, because they affect real estate in one way or another.
George, we just had a question come in already. So
right.
If you want, I can read that out
Sure.
to you. It says our organization is subleasing it to a company, and the company has a master lease with our building. Should we negotiate the lease with the landlord or just the landlord?
Okay, so that's a very, I'm going to get to that. I'll write that down, and I will get to that. One thing I wanted to add is, feel free to ask your question. I come from a large family, and we're used to being interrupted and ask questions. So I love the questions. I will get to that question, because that I'm in that situation right now with the tenant. So, but as I said, all of these issues affect the real estate in one way or another. So let's just take a look at a few of them. Increased cleaning. Well, the result of increased cleaning is there's a higher operating costs. If you're the tenant, some of that may be passed on to you, some of it may not. If you're an owner, if you're a nonprofit that owns a building, the result is higher expenses. Touchless entries and elevators, which is very common now in the Class A buildings in New York, but not in Class B buildings, and it's not in all Class A buildings. So that's a large capital expense to reconfigure your elevators. Staggered work hours. You know, that can help productivity, can hurt productivity, but it's going to change productivity, and it's going to change management. Social distancing. So that has an interesting impact, because some tenants and space occupiers are going to spread people out, and and that will require more space potentially. I think a lot of people are going into the sort of staggered work at home, come to work 2 days a week, work at home 3 days a week, or some variety of that. But I think the result of that is less collaboration. I know my own company, it's difficult to collaborate because you're not seeing each other. And there are certain personality types that thrive on being close to other people, and others, are okay on their own, but it's unequal through your workforce. So social distancing definitely has an impact. It probably, in general, I think there's going to be a large percentage of people that are just going to work at home to a great extent, which is going to call for less office space in the future. So that's definitely going to have an impact. Overall, I think the impact is going to be less demand for office space. Masks, I think there's no obvious impact on real estate. And commuting. As I say here, better by car, better by far. I think there's going to be a lot of companies that are going to say, you know what, being in the central business district is not necessarily the best place. Maybe we have an HQ there, but we have smaller offices spread out throughout the suburbs. This way people can go to an office, they don't have to get on a subway, they can drive, it's closer to home. So that has a definite impact on our on values and demand for office space, especially in Manhattan. So let's just look at the leasing market post-COVID. So I've had the opportunity to talk to some landlords, and I actually listened to a security analyst talk. It was an interview with the Empire State Realty Trust, which owns the Empire State Building and a bunch of other buildings in Midtown Manhattan. And the general rule was they were collecting about 70% of rent. Retail tenants weren't paying anything, basically. And then office tenants, there was a higher percentage paying. In general, office tenants were paying, but still the average was about 70%. In May, the expectation is 50 to 60%. Now I have to update this, but my guess is June is going to be as bad, if not worse, than May. And because of that, most landlords, I would say, have a negative cash flow. What does that mean? They can't go to the bank and say, hey, can I borrow some more money? They have to go to the partners and the owners and dig money out of their pockets to pay for expenses. Now, most people aren't going to cry crocodile tears for landlords, but ultimately that has an impact on everybody, every occupier and user of space. So I speaking to one owner, and they were telling me that they're making capital calls to a variety of their investors, and then some investors don't have the money to put in for a capital call. Others might. So then there's this whole litigation that's going to come out of, well, he didn't put in the money that he was obligated to, and so there's going to be litigation around. It's going to be a mess for owners for a while. And depending on how those LLCs and corporations were set up and how they were set up and how clear they were about capital calls. But there's going to be a cottage industry of people fighting each other who own real estate. The whole thing has turned the tables on landlords, because for years, the last 10 years, basically, it's been a landlord's market. And the vacancies were basically under 10% in most markets in the city. The suburbs for the last 30 years have been relatively soft. That is going to change entirely. But basically now it's become a tenant's market. Also, capital is tight. Again, if you own a building and you have a tenant wants to come in and lease a floor and they want the landlord to build it out, which is very typical, the landlord may not have the money to do that. And going back to, well, we have negative cash flow, so we don't have any money for build outs. So, and this is something that I experienced in the early 90s when the commercial real estate market was on its knees. But every transaction is very specific. It's very fact specific to that specific landlord, specific tenant, and the strength of each party is very important nowadays. So what I want to do is just go through an example of the financial impact of what we're going through right now. And I'm doing this so that in order to negotiate with another party, you really have to understand that other party's situation. The better you understand that, the better you can negotiate. And I'll give one quick example. I had a conversation this week about a fairly large nonprofit, and they had a member of their board take a look at their lease, and they contacted me to give them some advice, and they wanted to get a rent reduction of 50%. The problem is the landlord has no equity in the building if you're taking away 50% of his rent. So if a landlord would fight that tooth and nail. So by being overly aggressive and understandably, because the tenants are going through a hard time, but being overly aggressive, the landlord has no incentive to make a deal. You have to understand the landlord's position. If you understand the landlord's position, then you can ask for things that make sense that the landlord can then say, okay, that I can live with. And so that's what we're trying to do. So I'm going to go through this, and I know a lot of people may not be appreciative of going through all the mathematics, but I hopefully have done it in a way that you can follow through. But
George, before you get into the mathematics of that, we did have another question come in.
Okay.
I want to read it out to you. It says, is there a significant difference in the outlook for landlords in different geographic locations? We're in Dallas and we own a building with significant space leased to tenants.
Yes. And if I'm being too New York centric, I apologize. I actually used to work for a company based in Dallas for a number of years. Yes, again, it's very geographic specific. The Dallas market, I would say the Florida market, as a general rule, those markets are going to do better. They have very low they have no personal income taxes. It's going to be an entirely different set of circumstances. New York, just the fact that, 20,000 people died or something, some huge amount of people died. It's unbelievable. It's because of the subway system, the commuter rails. We're all concentrated in this tiny area. In Dallas, you don't have that type of issue. So I think the impact of COVID is going to be a lot less. And they'll open up faster. It just will be a totally different environment. Now, that doesn't mean they'll have some impact, but Dallas in general is spread. It's generally spread out. So it's more like a suburban market up here. So yes, there'll be an impact. It'll be a negative impact to a certain extent, but I don't think it's going to be as long lasting. I think places like Dallas, I think any place in Florida, certain states will bounce back much more rapidly than the Chicago's, the San Francisco's, where people are very concentrated. But let me just go through this. I hope that answers your question. Let me just go through this example, and this is if you're not from New York, you're going to think these rents are outrageous. But this is a typical Class B office building. A Class B office building is what you would think. It's everything that's not a Class A building, which are the newer buildings. So they're sort of mid-range, or I would say 75% of the companies in New York reside. And the market, pre-COVID-19 was around $55 a square foot. Now, every landlord has some vacancy, so that reduces the total revenue to the building. And there's a certain amount of tenants that don't pay any, in good times, and that's usually they collect around 95%. They don't collect 5%. So then the net revenues is around $50 a square foot. When you take the real estate taxes, which are around $12 a square foot, again, if you're not from New York, you're going to think, oh my God, who pays $12 in real estate taxes? Only in New York. And that's going to be important too going forward. And we'll get to that later. And operating expenses around 18. So the net before you pay your mortgage is around $20 a square foot. Now, post COVID-19, the vacancies have gone up. So anybody who had a lease, they let it lapse, so just the initial few months, any lease that came up, a lot of people just let it lapse. So the vacancies have gone up. The collections, now I'm being kind in this because I'm saying they're collecting 75%, but that number may be 50%. They may be underwater already, but say I'm being kind at 75%, so they're getting a net revenue of around 35. Now their operating expenses have gone up because now they have to do all this additional cleaning. So the net is around $3 a square foot. So we're going to take those two numbers, the $19 pre-COVID and the $3 post-COVID, and we're going to take a 4% cap rate. The cap rate is the number you use to determine a value, and it's based on interest rates. So at a 4% cap rate, that $19-20 per square foot puts the value of the building around $500 a square foot. Post COVID-19, with a net income of $3, and we're being a little kind on that, the value of the building goes down to $76. So there's a huge drop. Now, this also assumes that landlords are only going to collect 50% for the rest of the time they own the building. There's some assumptions here that really don't apply. So the lowest possible number is $76, but it's going to be somewhere between 500 and 76. Although, obviously a wide range, but the potential is $100 or less per square foot value. When you take that number and you add each landlord typically has a mortgage, and the banks prior to COVID-19 have been very, relatively strict in terms of loan to values. So in other words, if the value is $497, they'll lend up to $323 of that, which is very typical. It's 65% of the total value of the property. So that owner may have a mortgage of $323. That mortgage, though, because of the impairment of the value, is now worth around $50. So the bank has a loss too. So you can see the domino effect. Not only is the landlord's revenue being impaired, their costs are increasing, so they're getting squeezed. That in turn makes them unable to pay the mortgage. That inability now causes the banks to have a problem, because now the banks have a loss on this mortgage, and they have a loss on this mortgage. Guess what? They have a loss on every mortgage. And again, it all depends how long this lasts, because that $76 number only is if that's an absolute worst case. I don't think it's going to be an absolute worst case. It's going to be something in between those two numbers, and it really depends on how long this lasts. But everybody, landlord, tenant, bank, are all going to be impaired in some fashion, going forward. The good news is we've been through this before. So you can see, you know, the headlines, you know, there's a lot of suits. There's, you know, there's a report that, and this was in the Times, you know, that 80% of retail tenants miss their rent payments, and the office tenants is similar, you know, not as bad, but it's similar. This other article was a museum that was thinking of shutting because it, you know, it has no patrons and it, you know, has no revenue. Then there's the lawsuit about a frustration of purpose, and this is again, that's something to try to get out of your lease, to breach the lease because of the government's action, and we'll talk a little bit more about that. So, but compounding the landlord's issues is, you know, in those assumptions, I'm assuming you're still getting $55 a square foot. You're not. Rents are going down. Vacancy rates, they'll continue to creep up, especially if companies start to just say, you know what, some companies are just going to, you know, they're going to have a small headquarters and everybody's going to work out of their house, which is a huge savings for a company. So vacancies are going to go up. Capitalization rates, so the value based on the cash flow, that aren't as great because they're now considered way more risky assets. So the values are going to go down. Expenses go up, which I said. And this is the killer. The taxes, which for example, in New York, commercial property taxes pay about 1/3 of the municipal budget. They're going to go up because who else does the city go to? It's hard for them to go to voters, you know, residences, and say, hey, you know, let's increase your property tax on your house. So they're going to look at the commercial property cohort for revenue, and that's going to be an even bigger issue. I think do we have a question, Melissa?
It looks like we had some chats come through here. Let me read those real quick.
Nice.
Let's see. You can continue on, George, and I'll monitor these and read them out to you.
All right, okay. So the real critical issue, and even when when I did these projections, you know, I'm projecting like this never stops and it goes on forever. You know, the reality is it does stop. We're all going to get back to work. You know, there's a reason cities are popular, and that reason is not going away. People thrive with other people. You know, people have families and relations and what have you. That's never going to stop. People are going to like cities. I love being, I'm a New Yorker. I was born and raised in New York, went to school there. It's exciting, you know, and I think that reason is going to keep it going. So we don't know how long this is going to continue, but the longer it continues, the more it impairs everybody. That I can say for sure. And ultimately, because of that, you don't know what the real impact on value is. So let's talk about some samples here. Oh, sorry, I skipped ahead by accident. Okay. So if you are a tenant and you want to renegotiate your lease, and you know, the first question everybody asks, should I pay my rent? And if you talk to, I had a conversation with a lawyer yesterday. One of his clients came to him and said, you know, asked him that question. You know, as a lawyer, yeah, you have a contract. You have to, you know, you signed a contract. Yeah, you're obligated by the contract. But if you can't pay your rent, then you don't have a lot of options. You don't, you know, listen, you don't. So once you stop paying your rent, you're going to have some sort of response from your landlord. And because there's so many tenants impaired right now, you know, landlords can't possibly respond to every tenant. So, you know, that's why a lot of tenants, you know, I had a conversation with a tenant who's perfectly capable of paying the rent. And this is interesting. They had a subtenant in their space that was paying the tenant, and the tenant wasn't paying the landlord. And that's sort of interesting because if you're a subtenant and your tenant isn't paying the landlord, and depending on what your relationship is, if you have a non-disturbance agreement, there's a bunch of things that protect a subtenant in those situations, like a recognition agreement or something. Like if the tenant defaults and you're a subtenant, if you have a recognition agreement, the landlord will recognize you as the tenant. If you don't have that, you have no privity, you have no contractual relationship with the landlord, you only have a contractual relationship with the tenant. So you can, in that situation, you're dealing with the tenant. And if the tenant is not paying their rent, the tenant can lose its tenancy, in which case you then as a subtenant would also lose its tenancy. So depending on what that middle person, that tenant is doing, and it depends how you react. But in those situations, you would want to be in contact with both parties. Now you have to be careful in dealing with the landlord because again, you have no contractual relationship with the landlord. The tenant does. And so you have to be careful about not disturbing that relationship. So you have to be careful, but you can go through those issues and to come to a resolution depending on what the situation of each party is. So let's just go through, a little more simple example, and that's just, and I hope that answers your question, of a tenant that's, wants to renegotiate the lease. So the first thing the landlord asks is, let's see your financial, situation. What's your, you can't pay the rent. You don't have revenues coming in. What's going on, which is like the total opposite of what normally happens, is today, if you're a very strong tenant with a good balance sheet and revenues and what have you, you can't renegotiate. It's very hard for you to renegotiate a lease. A lease tenant's just going to say, pay your rent. And in fact, when I was listening to the Empire State Realty Trust, they were saying, even the tenants that have the money aren't paying, but they know they can get that money. They can sue and they have an opportunity to recover the money that those tenants aren't paying. There's a pot of money there. If you're a weak tenant, totally different story. You have a lot more leverage, because the problem with the landlord, as you can see, is now if he loses a tenant, replacing that tenant is going to be near impossible for months and months and months. So if you're in that range where you're not doing well, and you have absolutely a lot of leverage to talk to that landlord and renegotiate the lease to something more meaningful. So a lot of what's going on is really fact dependent on the tenant's financial strength. And the weaker the strength, the better off you are. It's very, I would never think I would ever say those words, because it's usually the complete opposite. The term, if you have a long term versus a short term, the shorter the term, the more leverage you have as a tenant. A lot of times tenants have termination rights in their lease and they forgot about them. The management was changed in the last 7 years, 8 years, and nobody ever really read the lease and said, oh, by the way, we have a right to cancel in year 7 and let's exercise it. So I had the opposite situation where a nonprofit had a lease and they had an option to buy the building, and they didn't realize that they wanted me to do a lease abstract. And I told them, you have this option to buy this valuable piece of property at, below market value. So knowing your lease is the critical. That's like, for a tenant, the first thing you do is you got to understand what your rights and obligations are, and that's all in the lease. Then you have things like a good guy guarantee or and a security deposit. Good guy guarantees typically not in nonprofit leases, but sometimes they are. And a good guy guarantee says basically that you guarantee that the rents will be paid during the occupancy of the tenant. But once you leave the occupancy, the good guy guarantee goes away. So, and that's also something, it's pretty common in New York. and the suburbs. I don't know how common it is elsewhere. But if you have a very large security deposit, tenants want to keep that. They don't want to lose 6 months rent. So those are all considerations. I had a tenant. They were in a space. They weren't paying rent. They had just spent money on an installation, but they also had a guarantee, a guarantee of the entire lease by the principal of the entity. So that's very difficult to negotiate your way out of. Landlord and beg for mercy because the landlord's got his foot on your throat. So all these things are very fact specific, and in that situation too, though, the landlord closed the building down. So if the landlord does something like that where he makes it unusable, then that's a constructive eviction. You don't have to pay your rent. So all of these situations are all fact specific. Again, if your default language, you have to read that. Now, typically those terms, default paragraphs and terms and conditions are usually not often negotiated, because basically it says, well, if you don't pay the rent, here's what happens. And landlords say, like, we don't care about anything else, but you have to pay your rent. If you don't pay your rent, we don't want you here. But we also want you to be obligated to pay the rent forever if you default. So default language usually is not helpful, but it's something you have to review. Force majeure. Again, there's a lot of talk about suing the landlords and saying force majeure is something like an act of God. It's something outside the contemplation of the contract. So neither party anticipated this. And so there's a theory that because neither party anticipated this, that because of that, we don't have to pay our rent, the landlord doesn't have to provide services, blah, blah, blah. So it's usually more to do with during construction. It's not so much that you cannot use you cannot enter or use your space. It's more about, there's a labor strike and you couldn't get the space built, and that's outside of what we anticipated. So therefore, we are going to get a relief in some fashion. But again, I read a force majeure clause the other day, and I was like, wow, this allows them to get out of this lease, because it was very broad and very tenant favoring. So again, the landlord's not going to agree to that. They're going to still argue no matter what it says, but sometimes there's opportunities in some of these leases that may be beneficial to tenants. What initially happened with tenants, and I had tons of tenants call me about this. Basically they call, they say, should I pay my rent? And say, well, you have an obligation, and if you can, you have an obligation, but there's strength in numbers and what have you. The response from landlords was almost, it was like it all came from the same source or something like that. It's like, you can get a PPP loan and you can use that money to pay the rent, so you should pay your rent. Very self-serving for the landlord community, and ultimately I think that kind of backfired. But that's what a lot of tenants, a lot of landlords did. So if you happen to be, lease is ending and you're looking for space in this market, that brings a whole new, I just want to check the time, a whole new dynamic. So here the issue is going to be the financial, ultimately the financial strength of the landlord. Because if a tenant needs space built out They need services. If the landlord's underwater and they're going to their partners and saying, put money into this building, and your tenant who's going into that building, I wouldn't. You got to know your landlord, and you got to know that the landlord has the financial strength and wherewithal to run the building properly, to build the space out, and to do the improvements that are going to be necessary, like keyless entries and things like that. So the strength of your landlord is going to be critical if you're looking for space. The other thing, just right now, no one really knows what the market is because there's been no transactions, or very few. So nobody really knows, is it $35 a foot, 45, 55? No, we know it's lower, but we don't know how much lower. And also we don't know whether the landlord has, the financial wherewithal, or whether the bank will back the landlord. Some will, some won't. Very important to know who you're dealing with, which is also, in general, one of the things that we as brokers do is identify those landlords which we feel are, reputable. They live up to their word. They do what they fulfill their obligations. Not all landlords have that reputation. Big surprise there. So anyway, we'll just move on. So let's look at ownership as a nonprofit. First of all, virtually all values are down. So if you own a piece of real estate, the value is going down. But most of the time that's irrelevant, assuming you're still using the property. So if you're using the property, it's irrelevant that the value is going down. But it's a very opportunistic time. So if you are a nonprofit that's been looking to buy a piece of real estate, there may be a lot of real estate that's on the market that will come on the market was heretofore unavailable. So there's a lot of opportunities, and there'll be more opportunities in the next few months if you're in the market to own. And if you have capital, this is a great time to be in the market to purchase. Lending, again, is going to be a little more challenging, but again, if you're a strong nonprofit with a good balance sheet and you have lines of credit and you can get bank lending, there's no time like now to purchase. So if you're in that thought process, and I know it's counterintuitive, but let me tell you, every real estate investor out there who worth his salt is looking for opportunities. They're all, I was talking to a family office in London who's looking to buy hotels in New York, or New York, LA, San Francisco. And you're like, okay, how much under what it was previously valued, are they willing to sell it? 50%, 60%? So there's opportunities. And for nonprofits, there are a lot of benefits to that. And the biggest benefit is that you don't pay property tax. And in high tax areas like New York, Chicago, San Francisco, not owning real estate, not having tax exempt is a huge value. So again, if you're in that position, it's a great time to be in the market to purchase. The downside right now is that the government funding is questionable. But a lot of times, especially with the nonprofits that provide housing, and now is definitely a good time to buy. And if you need zoning approvals and the fact that you want to build something in this kind of market, I think you're going to get great reception, even if it's something that people don't particularly want in their neighborhood, the not in my backyard type of things, which a lot of nonprofits deal with. Creating economic activity is going to be looked positively at this time. So it's definitely a good if you have the money, it's a great opportunity. But one of the things I always tell my nonprofit clients, and which I think is very important, real estate We'll look at real estate like it's a great investment. As I said, I did work for the Children's Aid Society. They got a piece of property in 1909. They sold it a couple of years ago for, $25 million. It was a huge value increase. And it's interesting. If you took that and did for 120 years, I'm not sure what the exact number would be, but it would be way more than what the value of that real estate is. Real estate goes up with inflation, basically, over long periods of time. The problem with, or the benefit of owning real estate is it's illiquid and you can't buy and sell it every 5 minutes. With stocks you can, and the danger is if you have a stock portfolio, you do that. Stocks go down, you sell everything, you buy them back when they go up. Real estate, you can't do that too well. So that's why it has this sort of built-in value. And for a lot of nonprofits, it's a great investment just because they can't sell it every 5 minutes. So, but you have to look at it. Don't think it's, oh, it's a great investment and we're going to make huge amounts of money. That is, I think, a misnomer of it. And so just to get to our conclusions from today's talk, there's a lot of uncertainty. Nobody really knows what the answer is or how long this is going to last and how best to do things. You do the best you can under the circumstances, but we could fret on every single issue we have here. But I think if we just use common sense, just like wearing masks when you're out in public, cleaning your hands, it's the same thing, apply that to real estate. Do things that are sensible, you try to be fair, try to understand what the other side's trying to do so that you can get to, what we do as brokers and consultants. We're trying to get people to agree to things that that work for both parties. So, you do that by being practical. Winning things on principle don't really work in the real world, but so you have to do the best you can given the situation you're in. Most values are lower. Whatever you're doing, the values have gone down. There are many opportunities. As I said, if you're in the market, it's a great time to be in the market. My advice to my clients, know what you have. Like if you have a lease, know the lease, assess, analyze, plan, and then make a decision. One thing you have to, I think, and I'm on boards and stuff like that, you got to understand if your business model is no good anymore. It doesn't work under these environments. The quicker you can make that decision, I think the better off you are. And as always, take precautions, and we'll all succeed. Any other questions, Megan?
Yeah, we did have a question come in, George. Thank you. Someone asked, which is a really good question, how are shared spaces affected by this? For example, like WeWork. How are they affected?
Okay, so I've been betting against WeWork for a long. I don't think WeWork's going to. It's going to file Chapter 11 at some point. Because it just that again, as I just said, that business model may have worked. It doesn't work anymore, and so and simply because now you have to spread. Before you put 5 people in a 10 by 4 space. It was ridiculous. That's all got to change, and so the whole economics of that environment has changed. So my sense is that that model is not going to last. But what will have, and I think also because that was launched at a time when the economy was growing rapidly, and you can get away because they were buying retail and selling retail, and that only works when prices are moving up. When prices are moving down, they bought on old prices, higher prices than what you get now. But what's going to happen is, I think a lot of those will go back to the landlord, because a lot of them they're not paying rent on now, and it gets back to that tenant subtenant issue. Because in WeWorks, you're not even a tenant, you're a licensee. But there will be other people that come in and replace it. I think the concept is here for good. The shared office space is here for good. But I think there's going to be a huge retraction in the short term. But once people feel more comfortable about it, with appropriate controls, I think there's definitely a market for that. And there always, that's a work style that's going to work for a lot of people going forward.
Yeah, thanks. And we did have another question come in, and I'm kind of interpreting this question as to what I thought it meant. So please correct me if I'm wrong, to the person who asked it. But in the nonprofit industry specifically, what is your advice to nonprofits where collaboration is really key for employees in the nonprofit industry? What's your advice if they're trying to save a little bit of money? The thought of kind of moving to more work from home permanently, the kind of cost savings of that versus losing kind of collaboration with being in an office space just to save money. What are your thoughts on that?
It really depends on what the what the business is per se, but I think I think a lot of it is with regard to the collaboration and working from home and what have you. Some people are going to thrive in an environment like I like being around people. I enjoy the interaction. That's what I do for a living. But I can also, I feel comfortable, being in home and working from home by myself. But there are people in my office who can't function. They just literally can't function outside the office. It's just not in their personality. And I think it's more of a personality thing than it is a, anything but that. I just think some people thrive with other people and some people don't. And if you know who does and who doesn't, maybe that's a way of separating people, and maybe do personality tests, and these people really need to be around, and let them come in, and those people, well, they like to be by themselves anyway, so let them be at home. I think from a business standpoint, cutting costs is going to be a big deal as government funding is being cut, and fundraising is being cut, diminished to a great extent, and will be. I think a lot of companies, it's going to be important to cut your cash obligations. So I think going to some sort of downsized model is what most companies will do. They're not going to have it, everybody gets a desk and everybody sit next to it. That ain't going to happen anytime soon. I think what's going to happen is every company is going to do it a little differently depending on what they do, who they serve. But I think it's going to be more of a personality issue than anything to get that, okay, they work good from home, or if there's some creative project where it really requires collaboration, then you have to bring people in. I think you have to sort of test, experiment, see what works, and I think that's what, the nice thing is none of us really know what the answer is. It's all a big experimentation to a great extent. So, there's no harm in not knowing. It's I think in a sense is, well, I don't know. I'm going to do the best I can. I'm going to kind of let common sense, and experiment. And I think companies, it'll evolve, and they'll make mistakes, and they'll find things that really work, and then they'll find things that really accelerate. You know, there'll be innovation that comes out of this too. So I think there's lots of opportunity here, but I also think, you know, take a breath. It's, you know, we don't know. You don't know. I don't know. We do the best we can. I hope that answers your question.
Great. Yeah, great. We just had another question come in, so I'll let you get to that really quick, George, as well, in the time we have left. It says, one issue is young people in terms of their first job. That would be my concern about working from home, as well as people new to an industry or company. So I guess the question's kind of asking, is the issue of young people in terms of their first job immediately going to a work from home environment? But that might go back to what you said earlier.
Yeah, I think it does. You know, that's not going to work. You know, if somebody's new to working, they need supervision. They need careful supervision in the beginning. They need training, what have you. I've had new employees come, you know, fresh from college, and let me tell you, no offense to young people, but they don't know anything coming in. I shouldn't say that. It's a little stark, but they need to be trained. They need to understand how things work, how your company works, what your values are, things like that. That's very difficult to do remotely. They need to be, you know, there needs to be some supervision. Now, does that need to happen, you know, 5 days a week, 8 hours a day? That is where you can start. Okay, you have this task, stay home tomorrow, do this task. You can watch, you know, everybody's productivity, you know, you can get on their computers, you know exactly what they're doing or not doing. I mean, Big Brother is here in terms of that. But having a dedicated office space to people is expensive. And I think companies are going to say, you know what? Yeah, this guy has to be in for the next 30 days. He's got to be in every day. But, you know, once that's over, he should be able to work, you know, 1 day a week from his house, and then maybe 2 days. So I think, again, as I said before, you know, it's an experiment. You do the best you can with the you know, capacities you have.
Yeah, great. Thank you so much, George, for answering those questions, as well as for the wonderful presentation you gave. I know we're almost out of time here, so I just wanted to say, what is a good way for people to get in contact with you if they have questions about the webinar, or maybe are just looking for space, especially being in the New York area? What is a good way for them to contact you?
We also we're affiliated. I'm affiliated with the International Tenant Representatives Association, which is a worldwide group of people that do what I do. So we do have offices throughout the country, but my office is in New York, and I do a lot of work in the tri-state area. And if people have questions, I welcome questions, so feel free to call me. I know this stuff is very stressful for a lot of people, but my number's 646-312-6800, and that's my direct line. I can also be reached by email, which is Grace, GRACE, at gegrace.com. Thank you. And Megan,
yeah, great.
We'll
go ahead and put that. We'll go ahead and put George's information in the follow-up email that you get as well. So you'll have his email and phone number to reach out to him directly. I know we're about out of time here, so I just want to thank you so much, George, for your time today and presenting. You gave great information. I know a lot of people have a little more ease of mind after your presentation, just knowing what they didn't know before. And we just thank you all for coming today. We hope you also join us for future events and webinars as well. And you can find out about those by visiting our website, www.jmtconsulting.com, and clicking on the events tab. We're right at the top of the hour here, so we will go ahead and wish everyone a good day. We hope you're staying safe and healthy and continuing to be at this time. We just thank you all for joining us today. We wish you a good rest of the day.
All right.
Bye.
So long. Thank you, Megan.
Thank you.